Managing Director at AlfAccurate Advisors, is with us. Rajesh, thanks for joining in. Before we get down to more individual themes, just your sense on how money has moved, because when the earnings season started, there was this flight of capital from IT. Then we had the bank numbers starting to come in, and it seems that that part of the market is a little more buoyant. In terms of large cap allocation, just tell us how you're going up, dividing the incremental flows that you're getting.
Well, I think, no major change in terms of our views, As far as IT sector goes, we have been underweight IT from almost last, I would say, 1 year plus. So we actually reduced our weightage on software sector in March 2022. The days when Russia-Ukraine war was announced, the days when Fed has already announced its war against inflation, and therefore it is obvious that the US is going to enter into a slow growth lane. And of course, the valuations of IT stocks that time, I'm talking about 1 year back, they were almost like, which is a perfect picture kind of thing. Everybody was assuming 20-25% sustainable of the earnings growth, and then very high PE multiples compared to its own 10 years average multiple. So, and hence we reduced at that time. And now, of course, in our thesis is coming right, and we still remain underweight on IT sector. I think it will be more of on our watch list, because now, of course, the valuations have corrected. But I think growth is still going to be a little bit under question mark. And right now, at least we are not yet buying. We remain underweight on IT.
All right.
Capital goods is one theme which we continue to like. No change in that. Banking is one thing which we continue to like, no change in that. And of course, incrementally, we are further adding to our, consumer sector weightage. We believe the worst is over for the consumer sector. So these are the three sectors on which incrementally we are positive.
All right. Among the other underweights that you have, Rajesh, is pharmaceutical as well. Now, at an index level, the pharmaceutical index has been one of the better performers this month. It's recovered about 9%. Individual stocks doing extremely well as well. At what point do you start looking at pharma once again? Do you continue your underweight despite the outperformance in the last few months, last few days, or you believe that now is the time for you to revisit your position?
To be very frank, Nigel, nothing much has changed fundamentally in last 2 weeks, except that, the index actually made a kind of a new low, and probably that attracted some flow. So very difficult to know, why it moved up. And of course, there are reports that, the new products are getting restricted because of the lack of approvals or new facilities by US FDA, resulting into some pricing stability in US market. Well, that's right, but the problem is the growth is not yet back, and we are still monitoring it. So I think pharma from here on is going to be more bottom-up opportunities rather than top-down opportunities. I think top-down is not going to look that great for pharma sector, at least in the near term. So that's our view on pharma.
All right. Hi, Rajesh. This is Nigel now. Mangalam asked you the earlier question. Rajesh, y'all have been generating good returns, and as you spoke to us last time as well, you said that you'll move your portfolio around, and that's how you're getting that alpha for your investors. What about the insurance space? Banking is something that you like, and as a percentage of your portfolio, I think that has the biggest weight. But insurance, is that providing an opportunity, or you will stay away from that space as well?
I think we are holding the large banks, which in turn have subsidiaries, into insurance space, both general as well as life. So it is better to play through that. I don't think insurance is providing a great opportunity to invest. The penetration story, of course, on that macro driver looks very promising. But important is how the actual growth is coming back. And I don't think at least next 4 to 7 quarters probably are going to be challenging mode. Also, sector probably will get more regulations kind of thing in terms of both on the distributor side as well as on the kind of a product side. And that makes me a little bit kind of I would say, cautious on insurance space. So we are not too bullish on the insurance sector in specific for the medium term. And I think when you play the large banks, anyway, we are buying those insurance things in a small way, am I right? I think that's a better way to play through. So we continue to remain, very bullish on the banking sector. I remember last time we were discussing on the net interest margins, and I was mentioning that I think at least for next 1 or 2 quarters, I don't think that is a challenge. And look at the numbers of the the top tier banks which have announced their results recently. The NIMs have continued to remain very strong. So I don't think NIM is a worry, at least for another 1 or 2 quarters. And the non-food corporate credit growth is improving. Asset quality trends are very good. They are very healthy. India is coming back on growth. And I think this sector will do reasonably well.
Rajesh, just one quick question on consumer. You said you like consumers. You will put more money to work in the consumer sector because the worst is over. In that, what are the pockets that you like? How would you select your individual stocks?
I think after probably lull of almost, I would say 2.5, 3 years, we believe both the segments, discretionary as well as non-discretionary, will do well. Remember, last 2 years, we were more bullish on the discretionary side. But from now on, we are equally bullish on both discretionary as well as non-discretionary. One, of course, important reason is we think that rural demand growth will bounce back, which has been impacted in a big way last 12 months. I think the rural demand growth is going to bounce back. Number 2, the focus on a better product mix remains the strategy of most consumer players. Number 3, the raw material cost, which was a major concern, which impacted the operating margins of most FMCG players. I think it will now work as a tailwind rather than headwinds. And number 4, importantly, again, we need to be selective, but I don't see major problem in terms of people are saying now whether urban will slow down. I don't think that's going to be bad. And if you look at the valuations, while the valuations look rich, but if you look at last 5 years market cap growth, and you plot it against profit growth, they are almost like 1 time. So it is not that market cap growth has been significantly higher than the net profit growth of most of the companies. So valuations are at their last 5 years average valuations. And I think that provides a good entry point if one has a 2-3+ years of view. I think from here on, one can make decent money in consumer space.
All right, decent money in consumers. Rajesh, always a pleasure speaking with you. Thank you so much for joining in and giving us your sectoral picks as well as preferences for sectors within those sectors as well. Hope to speak to you soon again. But now it's time for our favorite D Street Chatter segment, and not before